Hey, this is Shane Cass with Keller Williams and Stanton Residential. Today I'm going to talk to you a little bit about why I think it's an okay time to buy, even with inflation, interest rates, rising prices. If you're wanting to do this and you can afford to do it comfortably, why I still think it's a good time. So this is a question people ask me all the time. They want to buy, but they're like, "Is it a good time to buy? Should I or shouldn't I?" So I want to go through some of the actual numbers here. So the first thing here, this is going to be like this whole presentation is going to be based on these numbers. Hypothetical $425,000 purchase price with a 3.5% down payment, which is basically the minimum that most people need to have unless they're getting assistance with that. That equals about $15,000, and rates have been kind of sometimes higher than this, sometimes a little bit lower. We're just going to go with a rate of 6.5% for the purposes of this conversation. So just keep that in mind as I go through this. The first thing I want to do here is just kind of show you this chart. If you are making a $15,000 down payment on a $425,000 house, that's this top row here, and we're looking at a 10-year horizon here. So this isn't for, like, if you're thinking about buying and moving in 2 years, I'm probably going to say it's never a good time to do that because you never know if you're going to be able to make that money back in 2 years. But a 10-year horizon is generally pretty safe. So I'm going with 10 years. You want to buy, you've got a good, solid, long-term plan in place. That's going to be about a $15,000 down payment. Over 10 years, you will have paid $62,000 in principal towards your loan, and your loan balance will go down to $348,000 at year 10. Now, this this column here, home value at 2 to 3%. That's 2 to 3% appreciation annually. That's a very conservative estimate. Things are good, you might see 5, 6, 7%. If things are kind of down a little bit, you might see 2 or 3%. For the purpose of this conversation, I'm going to be super conservative and just say 2 to 3%. If you see appreciation at that rate over that 10-year period, might include a year or two where it's kind of down, and it might include a year or two where it's up more. Your home value will be somewhere between $518,000 to $571,000 at year 10. That means your equity will be between $170,000 and $223,000 at year 10. That's an annual return on your 15K investment of 27 to 31%. That's powerful. 450K or 500K, you see those numbers go up a little bit. The annual ROI stays the same. But the point really is what the leverage of real estate is the forced savings plus the appreciation. You are paying interest, and I'm going to get to that in a slide or two and just kind of show you what that looks like because I don't want to hide that. This is like you're putting money into the house in the form of principal, which is lowering your loan balance, and then the house is appreciating at the same time. Those two things combined equal your equity in year 10 being pretty high. So that's the case. That's, in a nutshell, that's the case for it right there. Next slide. So homeownership versus the stock market. So we're looking at that 425. Let's turn that 15K into 170 to 223,000 over time. Again, through the combination of appreciation and paying down that principal balance. If you put that same $15,000 into an index fund in the stock market, in 10 years it would be worth 24 to 39,000. So not bad, but not the same leverage that you get with home ownership. That's why you see over time, investors and everybody just goes to real estate as one of the most solid returns on their investment. That's why everybody wants to get into the home market because it's right there in the numbers. That 15K gives you leverage over an asset that's going to appreciate. You're paying down that mortgage balance, and at the end, you have a lot of equity. So if you're paying a landlord, let's say you're paying $2,000 a month for 10 years, that's $240,000. I mean, this slide kind of speaks for itself. That's going to your landlord. Most likely it's paying off their mortgage, or maybe they've already paid off their mortgage and that's just going straight into their pocket. Okay, So sit on that number for a while. In reality, your rent's not going to stay, it's not going to stay fixed for 10 years. Your mortgage payment is going to stay fixed for 10 years. So that's why we call it a 30-year fixed rate loan if that's what you're getting. You're going to have pretty much the same payment. The only thing that can go up or down a little bit, or usually up, is taxes, but not usually very significantly, not impacting that payment a lot. But rent, that's probably going to go up. This might look more like $300,000 over 10 years right now. That's going straight to your landlord. So here's a little bit more about where the money actually goes. I talked about in the previous slide. I'm not gonna just sugarcoat the fact that you're look over the fact that you're paying interest. You are paying interest, but that is the cost to control that asset. So with that $425,000 home, $15K down, 6.5% interest over 10 years, $62,000 of that will go to your principal, and $250,000 of that will go to interest. That's a lot, right? So there's no hiding that. That's a lot of money. But again, that's the price that you're paying to control that asset that's actually going to appreciate over time. And by the time year 10 comes along, it might be a $550,000 asset, not a $425,000 asset, or even more, right? So again, I'm trying to be conservative here, not to paint like some super rosy picture for you, right? But the numbers still look pretty good. And again, so would you rather pay $250,000 in interest going towards an asset that's going to appreciate and make you money over time, or just give that money to your landlord and have no return for it, right? So that's really the case right there. The last slide I'm going to share with you is people are going to say, well, Shane, what about pricing? Like, I'm waiting for the market to crash. The market doesn't usually crash, right? This chart is going all the way back to 1965. These gray areas are recessions. So you can see what real estate has done in the time of a recession. The only recession where real estate did not go up is the 2008 financial crisis. Now that was kind of an anomaly, similar to maybe the Great Depression where the banks were failing. Prices did go down, but eventually you could see if you were holding on to an asset in 2004 or 5 to 2015, you still did okay. You didn't have monster returns. But I think this recession was kind of an anomaly, but the biggest point to take from this is over time from 1965 to where we are now. I'm looking at the blue line, which is average home sales. The red line is median home sales. The green line is like a home, the S&P National Home Price Index, which is kind of a different number. But you see they all kind of rise and fall together. But average home price is that blue line. Since 2022 or 3, we've seen it kind of level out. Now, we still haven't hit a recession. We might right now, but one could argue that as soon as we get through this current sort of financial crisis that we have, which is nothing like the 2008 one, you're going to see interest rates fall and prices start to go back up as activity comes back into the market and all that pent-up demand comes back. So, if the market was going to crash, it probably would have already. This chart in 10 years is probably going to have a similar upward trajectory. So that's why I'm saying 2 to 3% is probably conservative, but even if it is just 2 to 3%, I'll go back to that slide. That's going to be $170,000 to $223,000 in home equity that you have that you can sit on, or you could sell that house and buy something bigger or better or across the country or whatever it may be, something that suits your needs a little bit more. So that in a nutshell is why I still 100% wholeheartedly believe in the power of real estate despite the challenges of getting into this market. If you can get in, I think it's still a great time. If it's the right time for you, it's the right time. So feel free to reach out anytime, leave comments, like and subscribe if you like this content. Appreciate you watching, and I'll see you next time.